Welcome back to Investing Talk Podcast.
Today we're looking at BlackBerry.
As usual, before we start, subscribe, like, and comment to this video to support the show.
Yeah.
Now, I have to stop you right there. I need to be brutally honest.
Okay.
I feel like half the people listening just check their calendars to see if we've time traveled back to 2008. BlackBerry. Really?
I know.
Are we actually looking at a dead phone brand, or is it just another one of those, meme stock situations? Because from where I'm sitting, this looks like a legacy company that just missed the boat.
That is the instinctive reaction, and frankly, it's the biggest inefficiency in the market right now. But here's the reality. If you're still thinking about physical keyboards and BBM, you are looking at a ghost. That company is gone.
It doesn't exist anymore.
It doesn't. What we're analyzing today is a completely different animal, a misunderstood software pivot that, based on the data from Q3, has just hit a massive inflection point. This isn't about nostalgia anymore. It's about hard numbers.
Inflection point is a buzzword I hear a lot. Usually it just means we stopped losing quite as much money. Is that what we're talking about here? Just slightly less bleeding?
No, this is the real deal. We are talking about a shift to genuine profitability. They've completed the transition. They're a pure-play software company now.
Focused on what, exactly?
Two massive sectors, IoT, the Internet of Things, and cybersecurity. But here is the headline that matters. Total revenue beat guidance at $141.8 million. That's up 9% quarter over quarter.
Okay, that's decent.
But the aha moment, they swung to a GAAP net income of $13.7 million.
Hold on, I want to clarify that. You said GAAP net income. We're not talking about adjusted EBITDA or some other funny money number where they ignore all the bad stuff.
Exactly. This is GAAP, generally accepted accounting principles, the strictest measure. They went from a loss last year to a hard profit of almost $14 million.
Okay.
This is the signal that the painful restructuring phase is effectively over. They are now generating real bottom line profit. That changes the risk profile completely.
Okay, that definitely changes the conversation. But let's be real, $14 million isn't exactly empire-building money yet.
Yeah.
So let's get into the weeds. Where is this $141.8 million coming from?
It's really a tale of two distinct businesses. First, and this is the crown jewel in my opinion, you have QNX.
Their IoT division.
Right. Revenue here hit a record high of $68.7 million, up 10% year over year.
QNX. Okay, let's define that properly. It's an operating system, right? Like Windows for cars.
It's an operating system, but comparing it to Windows actually misses the point. It undervalues what they do. QNX is a real-time operating system, or RTOS.
Okay, break that down for me. What's the fundamental difference? Why should an investor care?
Well, think of it this way. If you're on your laptop and you click an icon and it lags for a second,
Yeah.
you get annoyed, right?
Sure.
An RTOS, like QNX, is deterministic. That means if a sensor detects an obstacle, the system must trigger the brakes within a specific microsecond, every single time. No blue screen of death.
Because if the brakes buffer or the airbag sensor lags, people die.
Precisely. The stakes are life and death. That is why QNX is the bedrock of the software-defined vehicle. It's not just running the radio anymore, it's running the driver assistance systems, the autonomous functions.
So that's the IoT side. What about the other half of the revenue?
That's the cybersecurity division. Secure communications. It delivered $67.0 million, also beating guidance. It's a high-margin business. Two adjusted EBITDA margins are running around 26%.
And what about the old licensing money, the patents from the phone days?
It's de minimis, just $6.1 million this quarter. It's basically a rounding error. So when I say the pivot is done, I mean it. The story is purely QNX and cyber now.
That's a relief, actually. It clears things up. And I saw they raised their guidance, too.
They did. Management bumped full-year expectations to a range of $531 to $541 million. When a company beats the quarter and raises the full-year outlook, it tells you they have visibility. They're not just hoping.
Okay, let's talk survival. Because for a stock trading under $5, my biggest fear is always dilution. Are they going to print more shares just to survive?
That's usually the death knell, but they've solved that. Because of that swing to profitability, they aren't burning cash anymore. They posted $17.9 million in positive operating cash flow in the quarter.
So money is actually flowing into the bank.
Yes. And the balance sheet is surprisingly strong. Total cash and investment stand at $378 million.
$378 million. That's a significant runway.
It's more than a runway. It's a safety net. It removes that immediate bankruptcy risk. They don't have to do a desperate dilutive capital raise at a low stock price. They can self-fund their own growth.
Okay, so they have the money, they have the profit. But let's pressure test the moat. The auto industry is ruthless. Why doesn't Tesla or Google just build their own system and kick BlackBerry out?
That is the multi-billion-dollar question, and the answer is certification and complexity. QNX is safety certified. For an automaker to build their own, they would need to spend years and billions getting it certified. It is a massive headache.
So it's a path of least resistance play for them.
It's a path of least liability play. If you build your own OS and it crashes, you are liable. If you use the industry standard that's already certified, you have cover. The switching costs are incredibly high.
It sounds sticky, but are they doing anything to ensure they stay the standard for the next 10 years? Or are they just resting on their laurels?
Definitely not resting. They've launched this initiative called QNX Everywhere. They've issued over 12,000 free non-commercial licenses and have signed, I think, 80 MAC-Us with universities.
Giving it away for free, that sounds desperate.
It's a brilliant long-term strategy. Think about how Adobe or Microsoft became standards. They got the students hooked.
Right.
Right now, BlackBerry has over 6,000 students building race cars and robots using QNX. When those students graduate and become lead engineers, what software are they going to use?
The one they already know inside and out.
Exactly. They're locking in the mental real estate of the next generation of engineers. You can't just buy that kind of loyalty.
That is smart. What about secure communications? Is that as sticky?
It is, but for a different reason. This is the gold standard for sovereign-grade encryption. We're talking G7 and G20 nations. Governments don't switch security vendors because a competitor offered a 10% discount. It's about trust.
However, I am looking at the notes here, and I see a metric that worries me. Net retention dropped to 92%. That means they are losing ground, doesn't it?
You're right to spot that. And we have to keep a close eye on it. It's a dip from 95%. It implies that while the core contracts are solid, they might be seeing some churn on the periphery. In a SaaS market, you want that over 100%.
So it's not a leak in the boat yet, but something to watch.
Precisely.
Okay, so fundamentally,
Yeah.
profitable, cash-rich, sticky product. Let's pivot to the charts. Because if I look at the stock price over the last year, it tells a very different story. It's been painful.
It has. The stock has declined roughly 30 to 40% over the last year. There's no sugarcoating that.
And right now, we are trading in that sub-$5 range. It feels like the market just hates it. Why should I try to catch a falling knife?
Well, I don't see a falling knife anymore. When I look at the technicals, I see a base formation. The steep crash has stopped. The line has flattened out and is moving sideways.
Selling is exhausted.
I think so. The market was waiting for proof, and now that the fundamentals are improving, the price is consolidating, it's taking a breath.
Well, what do the valuation models say? Is there an opportunity here?
There is a clear disconnect. If you look at data from Simply Walson, their discounted cash flow model puts fair value at roughly $6.15. That implies the stock is maybe 11 or 12% undervalued right now.
11% isn't exactly a screaming buy for a risky tech stock.
That's the conservative estimate. But look at Wall Street. Recent notes, like one from CIBC, have targets as high as $6. From the recent lows, that would imply nearly 58% upside.
Now 58%. That grabs my attention. That's a growth return. Are we seeing any momentum to back that up?
We're starting to see the signs align. The 50-day moving average is flattening. But more importantly, look at the volume. Post-earnings, we saw massive volume spikes. 20.4 million shares traded versus an average of about 14.7 million.
Volume precedes price. That's the old adage.
Exactly. Big money doesn't buy in silence. That spike suggests institutional interest is returning on the profitability news. And if you look at the RSI, it's in a neutral to oversold range. The spring is coiled.
So the charts say potential bottom. Let's bridge that to sentiment. Because despite the earnings beat and the guidance raise, the stock didn't exactly take off. It was a bit flat.
I call this the hated rally, or the potential for one. The reaction was muted because investors are in show-me mode. They've been burned by BlackBerry promises for 10 years.
They're terrified it's a fluke.
Precisely. They are waiting for sustained multi-quarter growth before they commit.
And the analyst ratings reflect that too, right? Mostly hold.
Mostly hold or neutral. They acknowledge the progress, but the skepticism is around the pace of growth. Is 10% growth in QNX enough to really get Wall Street excited? That's the debate.
Now here's where it gets really interesting. Or concerning. Insider activity. On January 2nd, the CEO, John Giamatteo, sold about 231,000 shares. The CFO sold some too. Why shouldn't I be worried?
It's a very valid concern. It looks terrible on paper. CEO sells is never a good headline.
It makes me want to run for the hills.
Right. But we have to look at the context. We haven't seen a cluster of exits. It wasn't the entire board dumping everything. This looks more like routine trimming, possibly for taxes or just portfolio management.
231,000 shares is a lot of trimming.
It is, but look at what he kept. If they believed the ship was sinking, they'd be gone entirely. And crucially, institutional data shows the big funds are maintaining their positions. The smart money isn't fleeing.
Okay, it's a yellow flag, not a red one. I'll give you that. But let's talk about the other headlines. This brings us to the bear case, and there's some ugly stuff here.
There is. We have to look at the risks.
Risk number one, the toxic culture lawsuits. There are specific allegations out there. A boys' club culture, harassment claims against the CEO, retaliation. This is serious.
It is very severe. Now, the company denies these allegations, but from a purely investment standpoint, this creates headline risk. It distracts management.
And it's an ESG nightmare, isn't it?
That's the bigger financial risk. A lot of institutional funds have strict ESG mandates. If a company fails the G or S part, those funds cannot buy the stock, no matter how good the financials are. It limits the pool of potential buyers.
That's a serious headwind. What about the business risks? Are they just a small fish in a big pond?
That's risk number two. Growth differentiation. They are competing with Microsoft, with Wind River, and remember that retention drop we mentioned?
The drop to 92%.
Exactly. Dropping to 92% suggests they might be losing some customers to competitors. If that number keeps dropping, the growth narrative falls apart. They need to stop that leak.
And finally, valuation optics. The PE ratio looks massive, something like 111 times earnings. Why would I pay that for a company growing at 10%?
It's a vanity metric at this stage. When you just cross from loss to profit, the E in PE is so small that the ratio always looks astronomical. It's distorted. But bears will point to it and say, look, it's overvalued.
It scares people away.
It does. You have to look at forward cash flow, not trailing earnings.
So, to recap, we have a profitable turnaround with a sticky moat and cash in the bank, fighting against a skeptical market, ugly headlines, and fierce competition. Where do we land? It's time for the verdict.
When I weigh everything, I'm giving this a bullish score of 7.5 out of 10.
7.5. That's fairly confident given the risks. Walk me through the final thesis. Why bet on this?
The bottom line is this. BlackBerry is no longer a restructuring story. It is an early-stage, profitable compounder. The downside is limited because they're trading near their cash and asset value under $5.
It's a solid floor.
It's a solid floor. But the upside, it's asymmetric. We are looking at double-digit to maybe 25% plus potential if they just execute.
So you're buying the drivers.
I'm buying the drivers. Record QNX revenue. Rising content per vehicle. Every time a car adds an autonomous feature, BlackBerry makes more money. And they have that $378 million cash pile to self-fund it all. They control their own destiny.
And the toxic culture stuff.
It's noise. Ugly noise, but likely priced in after a 30–40% drop. The market has already punished them for it. The stock is cheap enough that the bad news is already in the price.
So what's the time frame? A quick flip.
No, this is a 12 to 24-month hold. You are waiting for the market psychology to shift, for Wall Street to stop seeing that struggling hardware firm and start seeing a profitable IoT software firm. You are getting in before that re-rating happens.
A 12 to 24-month play for an asymmetric upside.
Gah.
I like the sound of that. It's not without hair on it, but the fundamentals are finally screaming profit.
Exactly. And one final thought for you to chew on. With that much cash, a depressed stock price, and a monopoly on car operating systems, does BlackBerry stay independent? Or does a tier 1 auto supplier, someone like Magna, look at that QNX business and decide it's cheaper to just buy the whole company than to keep paying royalties forever?
Now that is an interesting thought. A buyout target hiding in plain sight. That's the verdict on BlackBerry. Don't forget to subscribe, like, and comment to support the show. We'll see you next time.